Hello everyone, welcome to Lesson 4, Accounting Equation on the Fundamentals of Accounting. This lesson will cover the three fundamental types of accounts, the accounting equation and the extended accounting equation. These fundamental concepts are essential for mastering financial recording. By the end of this lesson, you will have a solid understanding of how these elements work together to maintain accurate financial records. These are the learning outcomes for today. We will start with the basics of accounting equation and build up to the extended accounting equation, as well as the key components in the equation, including assets, liability, and equity, and the key features and categories of these different types of accounts, and also understand the current and non-current assets and liabilities, as well as be able to define, calculate, and explain the key purposes of capital employed. Recall the accounting cycle we have studied in previous lessons. The accounting cycle consists of 8 key steps. In the accounting cycle, step 1 to 4 are called bookkeeping tasks, including identifying transactions, recording transactions, posting to the journal, and preparing an adjusted trial balance. We are still focused on bookkeeping. We're in the second step of the accounting cycle. First, what accounting equation is. The accounting equation is a fundamental accounting principle that shows the relationship between a business assets, liabilities, and capital. It is also known as the balance sheet equation. The basic formula is shown here. Assets equals liabilities plus equity. Put it simple, the three components in an accounting cycles are assets, which are what the company owns, such as cash, inventory, or equipment. Liabilities, which are what the company owes, like loans or accounting payable. Equity is the owner's residual interest after liabilities are paid. In general, liabilities is borrowing, and the less the better. Equity and assets are, on the other hand, positive things for a business. Why is accounting equation important? It is also the foundation of double entry bookkeeping. It ensures that a company's balance sheet is balanced. It is also a key tool for tracking and verifying financial transactions and essential for keeping financial reporting and analysis accurate. Every financial transaction must keep the equation balanced. There are also limits of the accounting equation. These ensure financial statements remain balanced, but just because the numbers align does not mean the company is in good financial health. The accounting equation cannot tell investors how well a company is performing. Investors must interpret the numbers and decide for themselves whether the company has too many or too few liabilities, enough assets, or perhaps too many assets, or whether its financing is sufficient to ensure its long-term growth. The key questions they might ask include, does the company have too much debt compared to its asset? Are its assets sufficient to support growth? Is there a good balance between equity and liability? Other limitations, including sometimes it's very limited in evaluating company's growth. It does not consider non-financial factors, and investors must interpret the number and decide for themselves whether the company has too many or too few liabilities. It also ignores market value and inflation. It does not show liabilities of a company. A company may appear financially stable in terms of assets and equity, but if it lacks cash flow, it may struggle to pay short-term obligations. This is the chart of accounts. Remember we studied accounts in double entry. This chart lists and categorizes the accounts that form the components of an accounting equation. An account is a record that summarizes all transactions related to a specific item. Common types of accounts included the three assets, liabilities, and equity. There are also revenue and expenses within equity. A chart of account is a structured list of all financial accounts, used by a business or organization to track financial transactions. It serves as foundation for the accounting system, ensuring that financial data is categorized and recorded consistently. As I mentioned, the main three categories of a chart include assets, what the organization owns; liabilities, what the organization owes; equity, owners, shareholders; investment in the business; revenue, income from sales; and expenses, costs incurred to operate the business. This slide shows the extended accounting equation built upon the 5 types of accounts, and it has to be divided into debits and credits, which follows the rule I have mentioned in our previous lesson. Debit increases on ADE and credit increases on LCRE. ADE represents assets, dividends, or drawing and expense. LCRE represents liability, common stock, revenue, and equity. The extended version incorporates revenue, expenses, capital, and dividends drawings, making it more detailed. And it follows the formula as assets equals liabilities plus revenues plus capital minus dividends or drawing minus expenses. The extended equation helps track financial health, including profits and withdrawals. Assets and expenses follow debit rules, while liabilities, equity, and revenues follow credit rules. Unearned revenue is a liability because the company has received money but has not yet delivered the service. Prepaid expenses are assets because they provide further benefits. This slide encompasses all the important rules and components and the key accounting principles. I highly recommend the students to remember the content of this slide. Features of accounting equation. The accounting equation is essential for financial reporting and business decision making. It ensures transactions are accurately recorded and provide insights into a company's financial position. The key features of accounting equation are always balances. The equation ensures financial integrity. Every transaction affects at least 2 accounts using double entry principle. If the equation does not balance, there is an accounting error. It reflects the financial position of a business. This can help in preparing the balance sheet, which provides a snapshot of company's financial health, which we will study in our future lessons, and can help decision makers making decisions or investors analyze the financial information to assess company's financial stability. Managers can also use it to determine whether to take on more debts or invest in new assets. This is also the basis for the double entry system. Every financial transaction has 2 effects, ensuring accurate record keeping. Examples is if a company takes a loan, liabilities increase, and assets as cash also increase. The accounting equation also helps in analyzing business growth, tracking changes in assets, liabilities, and equity over time, and helps evaluate business performance. If equity increases over time, it may indicate growth and profitability. Another key concept is about current and non-current. This category only applies to assets and liabilities, not equity. Assets and liabilities are classified as current or non-current based on their liquidity or time frame. In general, current asset or liability is expected to be used or settled within 1 year, such as cash or account payable. Non-current assets or liabilities expected to be used or settled in more than 1 year, such as building long-term loans. This classification helps assess a company's short-term and long-term financial health. So the differences between these 2 categories are in their time frame and also in their liquidity, as well as their impact on financial health. So if a company with more current assets than current liabilities, it is often considered financially healthier in the short term, while non-current items reflect the company's longer-term financial commitment and investment. Let us look closely at the three components of a financial equation. First one is assets. It's what a company owns. As a definition, asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. In accounting terms, assets are resources that business owns and uses to generate revenue. It is anything with economic value that a company controls and can be used for future benefits. And it is a resource that can be used to provide future production and generate future profitability. More assets increase the company's value, and it's a positive thing. An asset may generate cash flow, reduce expenses, or improve sales, and it may be either tangible, like a piece of machinery, or intangible, like a copyright or a logo. So fundamentally, assets can be classified into many types by convertibility. You have current and fixed assets, or by fiscal extensions. These are tangible and intangible assets, or by their usage, including operating assets or non-operating assets. Here are some questions about assets. Take a look at them. What are non-physical assets? Is labor an asset? How is computer software classified as an asset? How are current assets different from fixed or non-current assets? We looked at these questions closely. By convertibility, if assets are classified based on their convertibility into cash, assets are classified as either current assets or fixed assets. An alternative expression of this concept is short-term versus long-term assets. Current assets are assets that can be easily converted into cash and cash equivalents, typically within 1 year. Current assets are also termed liquid assets, an example of such including cash, cash equivalents, accounts receivables, inventory, office supplies, short-term deposit, marketable securities. On the other hand, fixed or non-current assets are assets that cannot be easily and readily converted into cash and cash equivalents. Non-current assets are also termed fixed assets, long-term assets or hard assets. Example of non-current or fixed assets include land, building, machinery, equipment, patents, and trademarks. By physical existence, assets are classified into either tangible or intangible assets. Tangible assets are assets with physical existence. We can touch it, feel, or see them. Examples are land, building, machinery, equipment, cash, supplies, inventory. Intangible assets are all assets that lack physical existence. Examples are goodwill, patents, brand, copyrights, trademarks, trade securities, license and permits, and corporate intellectual property. By usage, the assets could be used into operating assets or non-operating assets. Operating assets are assets that are required in the daily operation of a business. In other words, operating assets are used to generate revenue from a company's core business activities. Examples of operating assets include cash, accounts receivable, inventory, building, machinery, equipment, copyrights, and goodwill. Non-operating assets are assets that are not required for daily business operation but can still generate revenue. Examples are short-term investment, vacant land, interest income from fixed deposit. There are some special points that students need to pay attention. Buildings and equipment are rented under a lease agreement are assets. Partly finished items of output may be recorded as assets, such as work in progress. It's used to describe work of the business which is not yet completed. Examples are partly finished items in a manufacturing company, partly completed motorway being built by a construction company, or a continuing legal case being undertaken by a firm. Such items are included as assets because there has been an event in the partial completion of the work and there is an expectation of completion and eventual payment by a customer for the finished item. The relative future economic benefits of these assets have wide variation in potential risk. The second key component in the accounting equation is liability, which are what the company owes. Liabilities are obligations, or put it simple, debts that a company must repay. Liabilities are amounts owed to others. You can call them creditors. An increase in liability means the company has borrowed or owes more. Liabilities are also include loans, account payable, mortgage, deferred revenue, bonds, warranties, and accrued expenses, and earned revenues. And they can be categorized as a short-term or current liability, or a long-term or non-current liabilities. So liabilities could be money or money equivalents, but can also be something intangible or non-money oriented items. To look closer to the two types of liabilities, short-term or current liabilities are typically expected to be paid within 1 year or less. Examples are payroll expenses, account payable, monthly utilities, wage payable, interest payable, dividends payable, unearned or deferred revenue, installment loans payable, and so on. The next one, long-term or non-current liabilities, are typically expected to be due for payment more than 1 year past the current balance sheet date. Examples are rent, deferred taxes, payroll, pension, post-employment benefits, current portion of long-term debt, mortgage loans payable, common stock. Here is a question showing some special types of liabilities. These are unearned revenue, account payable, account receivable. Do you know whose debts these liabilities are? Are they yours or customers' debts? The answers are unearned revenue, your debts, account payable, money to be paid, your debts. Customer debts are account receivable, means it's your asset, it's customer's liability, and customer debt is not going to be recorded in your book. Then you treat it as an asset. Some more examples. If a law firm requires that a client pay $4,000 in advance for future legal work, the law firm will record the cash of $4,000 and also the liability to deliver $4,000 of legal services. The law firm cannot report the $4,000 as revenue until it is earned. This liability account could have the title unearned revenue or deferred legal fees. This shows the meaning of unearned revenues. As the legal services are performed and therefore are earned, the law firm will reduce the liability account and report the amount as revenue in due course. The third component of accounting equation is owner's equity, also is owner's claim on the company. This represents the net worth of the business after deducting liabilities from assets, which follows the accounting equation principle. It means the amount of money a business owner or shareholder would receive if they liquidate all their assets and paid off the company's debt. More equity means the business is less reliant on debt. There are mainly three types of equity: capital, which are owner's investment, basically money put into the business; retained earnings, which are profit generated from the business, are reinvested instead of being distributed as dividends. Thirdly, dividends or drawings, which are money paid to shareholders or owners, reducing equity. Equity can help company assess the overall value of a business. If a company has positive equity, it has enough assets to cover its liability. If a company has negative equity, it does not have enough assets to cover its liabilities. Equity can also determine how much each individual share of a company is worth. This helps shareholders decide whether they should invest in a company. There's a question, do you think a drawing account is a capital account? The answer is yes. For example, a sole trader will have a drawing account in which the owner's withdrawal or draws of cash or other assets are recorded. This is different from dividends because drawings tend to be related to sole trader business. The amount of the owner's draws are recorded with a debit to the drawing account and credit to cash or other asset account. This is equivalent to dividends in corporation, but they're different in terms of the scale and operation. It is debit balance will reduce the owner's capital account balance and the owner's equity. Here you can see an example. This is OTT activities. OTT began as a sole trader with a cash investment of $3,000. Later, OTT withdraws 500 from the business for personal uses. So these two activities are recorded in double entry as first, cash 3,000, capital 3,000, and two, drawing 500 and cash 500. And the third activity is the business have assets of $2,500 and will have owner's equity of $2,500 at the end of this financial term. That means the company has zero liability in order to fit into the accounting equation principle. This example shows a real-world example of equity in home ownership, demonstrating the concept of equity using a property purchase scenario. A family purchases a home with the following financial details. Home is valued as an asset, £180,000, and the down payment, which is the deposit owner put into the home, is £60,000. The loan is the liability, which could be the mortgage, which is £120,000. So the question is, what is the equity the family has in this property? The answer is £60,000, which is the amount of the deposit. The explanation is the family owns a home worth £180,000. They paid £60,000 upfront as down payment. The rest, £120,000, was capital finance, which is a liability. So the family's equity in the home is 180,000 minus 120,000 liability, which is the 60,000 down payment, representing their ownership portion. The example follows exactly the accounting equation assets equals liabilities plus equity. This demonstrates how equity is the portion of an asset owned outright, while the rest is covered by liabilities like mortgages or loans. This is another real-world example of the accounting equation using ExxonMobil's balance sheet as of March 31st, 2024. The equation ensures that all financial transactions are properly accounted for. Any imbalance would indicate errors in the financial statements. So the financial details are the company has total assets of $377,918,000 and total liability is given as well. The total equity was $213,052. This comes from Securities and Exchange Commissions in 2024. The question is, what is the accounting equation as of March 31st, 2024? We use accounting equation to calculate and see if the balance could be reached. So the accounting equation shows the two sides are balanced. Since both sides are equal, this confirms that ExxonMobil's financial records are correctly balanced. A further example, a business at the end of its first year of trading has assets of £10,000 and liabilities of £8,000. What important information is contained in the difference between these two figures? Again, a financial equation question, but it's being addressed in a different way. The answers are, using the accounting equation, we got £10,000 equal to 8,000 plus equity. Therefore, equity is £2,000, which represents the owner's investment or retained earnings at the end of the year. Equity represents the amount the owner truly owns in the business after paying off all debts. A positive equity, in this case £2,000, means the business has more assets than liabilities, indicating financial stability. If liabilities were greater than assets, equity would be negative, meaning the business owes more than it owns, potential financial risks. Now I introduce another key concept, which is capital employed. Capital employed, an important financial metric used to measure how much capital a business is using to generate profit. According to definition, capital employed, also called funds employed, is the total amount of capital used to acquire profit by a firm or a business. The purpose of it is to represent a long-term investment in a company and helps assess how efficiently management is utilizing resources. It is used commonly alongside return on capital employed (ROCE) financial ratio to evaluate profitability and efficiency of the business, which are going to come across this concept again in our future financial ratio lessons. It is calculated using two formulas which are showing here. The first formula, capital employed equals total assets minus current liabilities. This formula focuses on the total resources a company has, excluding short-term obligations, to determine the long-term capital used. The second formula is capital employed equals equity plus non-current liabilities. This formula focuses on the total resources a company has, including short-term obligations, to determine the long-term capital used. Here is a question relating to the two formulas. How can you derive from the first formula to the second formula? This question is quite tricky. It is actually about deriving two equivalent formulas for capital employed, an important financial matrix used to measure the total capital of a company in using it to generate a business profit. Here is the solution. The first equation is showing here assets equals to liability plus equity. Deriving the second equation, assets equals current liability plus non-current liability and equity. Then if we rearrange to focus on long-term funding, we got total assets minus current liability equals non-current liabilities plus equity. Then this gives us the second formula, which is exactly equivalent to the first formula. Capital employed equals equity plus non-liability. Why this matters? Capital employed is used to evaluate a company's financial health and efficiency. It helps investors understand how a company is financing its operation, whether through owners' funds, which are equity, or long-term debt. It is also used in return on capital employed (ROCE) key financial ratio. Here is a question for discussion helping to understand the concept capital employed further in comparison to equity. What are the differences between capital employed and equity? While these terms are related, they provide different insights into a company's financial position. The answer to the question is showing here. First, equity's definition. Equity represents the owner's stake in the business. It consists of initial investments, retained earnings, and any additional capital contributed by shareholders. Essentially, equity reflects what belongs to the owner after liabilities have been deducted from assets. On the other hand, capital employed is a broader measure. It includes both equity and long-term debt. This means that capital employed accounts for all the funds actively being used in the business, whether financed through shareholders' equity or borrowed capital. So why capital employed is important? Because capital employed includes both debt and equity. It provides a more comprehensive perspective on company's financial health. It tells us how efficiently a business is using its long-term financing to generate profit and growth. To summarize, equity focuses on ownership and financial returns to shareholders, where capital employed help us understand the overall financial structure of the company. Investors and analysts use capital employed to assess how well a company is utilizing its total long-term resources. In summary, these are what we study in today's lesson. Understand the accounting equation and extended accounting equation, and identify and understand the components of the three fundamental types of accounts and how they related to each other, and different categories as well. And also further understanding how current and non-current assets and liabilities are categorized, and the current and non-current concepts does not apply to equity. Finally, define, calculate, and describe capital employed and its relationship and differences to equity. Here are some questions that can be used in classroom for students to review and reflect. And can be group discussion questions. This encompasses the key topics we studied in this lesson. Finally, independent study and reading directions. So for this chapter's lesson, chapter 3 of the core textbook is recommended, and there are also further resources and links being attached for independent study. For further study, here are some additional resources, including quizzes and videos that students can watch. Those resources will help students to work on those concepts at home and consolidate their understanding. That concludes our lesson for today. If you have questions, feel free to send a message here with the video. Thank you for participating in this lesson. I look forward to seeing you in the next session.